Hi, everyone. I'm Rick Bensignor. Today is Tuesday, September 14th. It's Apple Day, Apple Event Day. And this is this week's In the Know Trader Show. Speaking of Apple, we're going to concentrate today on the info technology sector. We haven't dug deep into it in about 3 months or so, so I'm going to bring you up to date on as many of these names as we can get to. We'll also look kind of in a macro sense, like we do each week. We'll look at the Dow Jones and take a look at what the chart is suggesting at this point. We'll look at the QQQ, the NASDAQ 100 tracking ETF, and we'll look at the XLK, the spider ETF that tracks the S&P technology index. So it's going to be a very heavy day on the tech side. Before we get deeply into things, just a reminder to, if you're interested in our weekly ETF Tactical Trader Report, comes out Thursday nights and gives you a good sense of what I'm thinking about in the S&P, the most important benchmark equity index, and we get very specific on it. We'll also look at macro, the U.S. 10-year bonds, often gold, the dollar, perhaps oil, copper, stuff in the macro space before we get into the ETFs. I'll give you a brand new ETF idea each week to trade, and then I'll review in this report all open ETF positions we have until they are closed. That is the TTR, the Tactical Trade Report. We also have a monthly 7-Eleven report. The goal of that is to outperform the S&P by being in no less than 5 or no more than 7 of the 11 macro spider ETFs, such as XLK, XLB, XLE, and so on, to outperform the S&P. 1 year into it, we outperformed by 2.61% in our first year. And September is September is our second month of the new year. Last month, we outperformed by 18 basis points to start the year off also in positive, and so on. And cumulatively, again, we outperformed by over 2.5%, which is huge in the sense of, over time, most people cannot outperform the market. And we do it with a very rigorous approach of both quantitative and technical and market timing inputs to allocate over the 5 to 7 ETFs that we do. My email address to write me is rick@intheknowtrader.com. We are in the process of rebuilding our In the Know Trader website. The new one should be ready in a few weeks, and you're going to love it. It'll have lots of new things to it, whole sections on videos and training stuff, and I will tell you more as we get closer to releasing that. Okay, let's take this one step further here and take a look at the macro relative performance of the 11 sectors. So these are all relative to the SPY. So if we look at here, you can see obviously anything below the zero line is underperforming the S&P year to date. Above, it's outperforming. Energy still the leader by 13.45%, followed by real estate up 12% beyond what the S&P is up, 11% for the financials, and communication services up about 6.5% or so. Tech is darn close to the benchmark. It is not outperforming by anything significant this year. It's only outperforming by 2% as of yesterday's close. And look, in the case of technology, 2% could be 1 day's outperformance. Thus, it really has been hugging the benchmark. As you can also see, industrials, materials, and healthcare very close to what the S&P has done. The big loser, of course, is staples, underperforming by about 11%, utilities by over 8%, and consumer discretionary about 4.5%. So if you had asked me at the beginning of the year if real estate would be this far ahead, I probably would not have thought so. Financials, yes. Energy, we didn't get into at the beginning, but I just went overweight energy, I think it was 2 weeks ago or no more than 3 weeks ago. So we're kind of picked hopefully right near the bottom of the decline. in underperformance. This had been, you'll remember earlier in the year, this was outperforming by significantly more than double of what it's outperforming now. So it gave back a huge amount of outperformance. But we kind of did some bottom picking over the last couple of weeks and are back into the energy space. All right, let's start talking about energy. Well, actually, here let's go to charts first. Let's take a look at the Dow. So this is a weekly chart, and it's kind of interesting. You can see right here we're basically sitting on this shorter term uptrend line from March. So you've got a little bit of support here, as well as potentially from the conversion line, which is in pink, the leading line from the cloud chart. But if that breaks, let me show you some other key levels. The orange colored line here is the baseline from the weekly cloud chart. It's at 33,850 in the Dow, and just beneath there, you'll see the TDS low at 33,741. So you've got a little support there. And then if you go a little farther down to 32, right near 32,800, you have not only the bearish propulsion momentum level, which if properly broken would suggest that will go lower, but a lot of times all we do is sell down to those levels and don't properly break them, so they end up being bullish levels. And you'll notice that two longer term trend lines, one from mid-November or early when it looks like November of last year, the gap up, that's coming into just about the same place. If I take the secondary low, so down here is March 2020 low, the bottom of the big decline. The secondary low was early May. So if we connect that trend line, you'll see that that also kind of comes in the exact same place over the next week or two. So if we were to fall down to this somewhere near 32,800, give or take, you see that there should be some decent support there for the Dow. So I don't expect a huge market sell-off. Can we go further from where we are now? Sure we can, but I don't think we likely take that out. If we do, then you're going to start playing into the cloud, something we haven't done since the whole way up. But my guess is that this area in here would likely hold. As far as resistance and what we've been looking at, notice that we've had 3 weekly 13 signals since January of this year. This one came in just after 9. We had a very minor pullback from there. You got a 13 in here looking for exhaustion of trend, and for the most part, that actually, well, actually here, why don't we, we can put a line in there. So we rotated around there for months, not really gaining or losing much. And then we made another little minor new high, and now we've got a 13 and 9 again. So, look, could we keep climbing up here and getting multiple 13s and 9s? We certainly can. One of the things that the street has come out with. So last week, and this is important, a total of 6 of the major banks on Wall Street went negative the market, calling for basically 10 to 15%. No, I'll take that back. 15 to 20% pullback in the market. And those calls came, many of them came from within 1% of the all-time high. Now, in my 40 years on Wall Street, I cannot recall a time that half a dozen strategists on Wall Street from different firms all got negative at the same time when the market was essentially on its all-time highs. It's almost always the exact opposite. They're bullish at the tops. They don't get bearish at the tops. And the fact that so many got bearish at the same time has led to some of the decline, because if you think about 6 banks and the reach they have into the retail crowds as well as to institutional, it certainly makes sense that the market has seen some selling. It's very strange and uncommon to have that many banks put out a call like that at the same time when the market's within 1% of all-time highs, which to me means it probably almost likely does not happen. It would just be very against historical standards to have 6 banks call the top at the same time for a 15 to 20% decline. I don't see it. I think it's very unlikely. Could we get a 5% decline? For sure. anytime these days you could get a 5% decline because of how lofty the market's been. And not just since the March bottom from last year, but here I'll take off the cloud just to make it, some viewing simpler. But, if you go back in time and you add in, the lows all the way going back to 2009, which is down here at the bottom left, we've had this massive bull market. You had this big correction when COVID hit. And, we've been going up straight since, and it's been since last November that we even had a 5% decline. So it's back in here, that big 2-week sell-off, that we've seen a 5% decline. So sure, it can come anytime. And especially when I see 13s, hanging around, it certainly can come because they do suggest potential exhaustion of trend. But too many analysts at the same time calling for a top from all-time highs, unheard of. And therefore, whatever it is, it still likely is a buying opportunity, and it's just a matter of picking where you get in. And there are different ways to try to pick where that bottom's going to be. And bottom picking is not the forte of most investors, but I do not see a 15 to 20% decline coming. And so far, bears have been proven wrong virtually every time. So I'm not doing substantial selling in my account. I do a little. I got institutions to hedge a small portion of their equity exposure earlier this week in between S&P 30, 3480 to 3520. And I think we got up to 40, let's get this right, 4480 to 4520. And I think we got up to 4496. So we did get off, a minor hedge, but it's only on a small part of the portfolio. And I still think over time, the market can head higher. It's just not going to see the gains as easily as we've seen in the past. So that's my take here on the Dow. Let's take a look at the Qs, the QQQ. All right, so this is the NASDAQ 100 tracking stock. And actually here, let me go back to our PowerPoint because I do have a slide I want you to see. On the left is the composition of the sector weightings behind the QQQ. So if you go down to the bottom, you'll see technology represents 45.5% of the Qs, followed by communication services at almost 20%, and then consumer cyclical 17%, and a little bit drips and drabs of some other stuff. But a lot of times people trade QQQs when they're thinking about technology, and it's the first way. Oh, I'm bearish tech, Apple's selling off. Let's go short some Qs. And the thing is, I want you to see the difference between the QQQ and the XLK. Right, the XLK is the S&P Info Technology Index tracking ETF. It's 87.5% technology, and the other thing is basically financial services. So you get much greater exposure to the tech sector when you trade XLK. And so I just mentioned that because so many people will quickly go to the Qs. And look, they're one of the, behind the spiders, I think they're the second most actively traded ETF out there. And, the volume they do beats every stock every day. But don't be fooled, XLK is very liquid, and it is much closer tracking to the actual technology index. So that's why I wanted to, show this to you, because that is important to realize when you're trading, is that if you really get bearish on tech or bullish, you want to play the XLK, not the QQQ. If you want more diversity and are looking for the, the NASDAQ 100, well then sure, that's what the QQQs are. So now let's go back to our charts. And here's the Qs. Again, let's take a look. We had a 13 here over the summer of 2020. You get a quick 1 month pullback from there. Took about 3 months to get back to the level, the high of the 13. So that was a good indication of, to me, if you get a 3-month pause in a trend, yeah, that's a good signal. Here, you only had a 1-month pause in the trend, but 1 month straight down from that signal. And then again, it took about 2 months of sideways before we've made this most recent leg up. So again, you see that last week made the all-time high at 382 and change, almost 383. And this is a zone that I was looking from a high from. So I don't have a problem taking some chips off the table in Qs in general, especially if you've had this for a decent amount of time. I'm thinking anywhere from roughly 376, well, here, where's that level? 375.5 up to about 399. That 25-point range, which is probably about, I don't know, 7-8% worth of a move. Somewhere up in there, it's not a bad idea to take some exposure off. But also notice, and this is different for the S&P, but notice that anytime we did get a decent sell-off, both November, we held the clouds orange line, the baseline. And the sell-off we had early in the year, look what the low is, the orange line. Look what the low was in April or May. Here, it's in May. The baseline from the cloud chart. So right now, the baseline's down at 345. Again, that's a fair distance below where we are right now, or basically, yeah, trading, at 377. So that's what, 32 points. It's almost 10%, probably 9% down before you have where at this point, I'd again expect to find good support. If you don't want to, and to the upside, you have, what do we have? 3, 5, what do we say, 8? Yeah, it's almost balanced in here between what your downside risk is and kind of the max that I see going forward over the near term. So is it a crazy idea to take some off the table? Probably not. But if you want something that is potentially more willing to stay with the trend, then you look for a violation of the baseline. And you can find the cloud chart on StockCharts.com and many other places. It's either called Cloud Charts or Ichimoku. It's a Japanese model, and I find it very useful. So that's my take on the Qs. And then here, let's take a look at the XLK before we get into individual names. Let's see. Okay, that's a daily. Let me switch it to, here's the weekly. Okay, so here's the weekly chart of XLK, and you can see how similar this is to Qs in tracking. It's because almost half the Qs is XLK. But again, if you want the technology space, then XLK is the better thing to trade. Same type general rule, anywhere from 155 up to 165.5 or so is the equivalent of what 375 is to 399 in QQQ. Somewhere up in here, not a crazy idea to do some selling if you've been long. I switched this to a daily chart, by the way. Notice that we're right on this uptrend line from May's low. This third time there, we're against on the daily chart, the bearish propulsion level. So we haven't broken it yet. Assuming this closes up today, if you close beneath that level tomorrow and then gap down the next day, then you expect it to get down to somewhere around here, 153-ish, give or take. That would be the next target down. So that's the look on these. Now let's get to individual names. We'll just take this away and let's do Apple. So we'll look at weekly charts on virtually everything just to get more medium-term picture. And of course, what stands out here is that a few weeks ago, we have a 13 count, again, potential upside exhaustion. We got very close to 158 and change is the full propulsion level, the full bullish propulsion level. So that's, a target, and we got as high as 157 and change. This 13 doesn't get stopped out until you properly close above 165 and change. So you know, up in here again, if you're long, you want to take some profits in Apple. Not the craziest thing. I started off the show by saying today's Apple Day. You know, it's Apple's event at 1 p.m. Eastern time, where they're going to announce the new iPhones, probably the new watch, and who knows, maybe something else. So the key levels now on the downside, 138 to 130, yeah, 138 and change to 139. More important support down at 127. We've got the TDST line, in other words, where this leg of the move started from, and it's the top of the cloud, somewhere around there for almost the balance of the year. So 130 down to 127 or so, pretty darn important support. So again, it depends on if you're investing or trading. All right, Microsoft. New all-time highs about a month ago. Notice it's hardly sold off. If it gets a proper Friday close beneath, what do we have, 291.30, then look for it to get to 276 and change. You'll notice here too that since 2020's bottom, most of the lows came right near that baseline, a little above, a little beneath. Right now that's at 268. Visa peaked on a 9, I don't know, 6 weeks ago or so, and has broken some shorter term levels. If we take out what we have here, 220-ish, then look for 212 and then a test of the cloud. On the upside, you're going to have resistance now between 237 and 240. Get through that, then you get a whole nother leg up towards 260. NVIDIA. New all-time highs. Well, no, I guess it was a couple of weeks back. We're still hanging in there. Just been a stellar stock. Look where this was to start the year at 120, 132-ish, somewhere right where, I don't know, right around there. And the stock's, you know, $90 higher. Huge winner. Let's see. First support now is 219.91, and you'll see, you know, this week we got a little beneath it and bounced. So it's still maintaining that bearish propulsion level. If we close up above last Friday's close this Friday, we have to close above 224.78 this Friday. If then we break down beneath there next week and gap lower the following Monday, then you look for this to pull back down. Initial target 209, secondary target 188 and change. To MasterCard. So far, technically, I'd say one of the weaker names we've looked at, simply because this has actually made its way back down to the weekly cloud. And then, you know, it's been above. So we only had one close beneath it back in the March 2020 sell-off, the lagging line, which is the current price pushback 26 bars, did not break through its cloud. So this never went into a sell. And on a long-term basis, the really key level here is 283. And that's good for another almost, well, through the end of the year, and possibly even a little longer. So for long-term players, as long as this line, this blue line, doesn't break underneath 283, you're good. Otherwise, it's you've taken the bullish chart away. Doesn't mean it's pure bearish, but you've finally taken the long-term bull away. PayPal, double top this year. All right, and you know, you certainly have a range in those terms. So if we pull back, look for support at 225, breaks that, you look at 193. On the upside, if you take out, make new highs, look for some resistance at 333. Otherwise, it's in here, not much going on. Just it's a hold. Intel, one of the weaker names. All right, so made its high back there in 2020, got close in 2021. It's pulled back. Clearly, there's long-term support somewhere in here, down in the low 40s. So big, wide ranges. Recently got a 9 count. Didn't really get lower than the 9 count. Starting to turn back up. I will disregard the cloud on a chart like this because it's so choppy. You go above, beneath so many times. So you have to look at kind of the big range. if you're tempted, you know, it's not a terrible idea to think that we saw the low, and, you know, as long as we stay above kind of 53.5, 53 3/4, I think it's good to at least go back up and test the upper 50s here, 57.5, 58.5. You want to see that hold. Otherwise, like I said, it's going to 49. If you buy it down at 49, and that's your entry level, then you stop yourself out if it breaks under the low 40s, and your upside becomes, you know, much bigger. So from a risk reward point of view, you could wait, but the 9 count here kind of tells me that that's all it may go on the downside. Adobe, new all-time highs a couple of weeks ago, pulled back, bounced again on the propulsion level. So if we properly break under this level here, which is 649, so just kind of 641-ish on a Friday close, which can't happen this week. You can't properly break it because last week was a down close. The only way to properly break is to, the first step of it is it has to come after the prior bar had an up close, and it didn't. Last week was a lower close than the week before. So this is disqualified, and that's why it's kind of near-term bullish. But if it breaks, which it could happen because the market's still under some pressure, look for 608 and change as your initial target to the downside, secondarily 542 and a much bigger market sell-off. CRM, SalesForce. So I look at this as a double top. Doesn't have to be exactly, you know, look, we tested up darn close to there. So look at the lowest low in between. That's your potential near-term range. It's also kind of hanging here on the propulsion level. Last week was a down close. So even if we close beneath it on Friday, it's not qualified, which means it doesn't really have enough for me to aggressively get short. Could I take some profits? If it does, sure. Look at this as kind of your bigger range, the zone that I defined there. Broadcom, AVGO, it's got this 13 kind of has its risk level here at 498 and change. It just breaks above, but prints another 13. Now that 13's risk level is up at 525. This is kind of touch and go. Some would say, well, right in here should be support because it's where it broke out from, but we haven't broken out enough. If you're long, if you know how to use options, you could sell some covered calls with strikes, you know, 525 type strikes, something like that. Same thing. If you've had this name for a while, not a crazy idea to take some profits, but if you want to be more diligent and willing to risk a little and give back a little, wait for it to properly close beneath 483, or is that a 463? So it's about 464. Otherwise, this is still okay, but you know, this is definitely a transition point in here, and that is all we're going to have time to go through this week. Maybe next week we'll do the rest of this list. I'll have to see if anything else is in the news at the time that makes me want to look at something else, but I hope you enjoyed the show and got some value from it. I'm Rick Bensignor, and this has been In the Know Trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.